As I'm introducing a panel that I'm actually on, but I am delighted that we're actually going to be having this conversation. This is near and dear to my heart. We're going to be talking about ESG and where to start with ESG. That's environmental, societal, and governance themes when investing. This has become a pretty popular investing theme, but it's pretty controversial. It's become controversial in the last year or two, but we're going to get into that, how to get exposure to it as an investor, what you need to know, and how to really think through it. Morningstar's got some great tools on this on their website. We have some guides on Investopedia, so we're going to get into it right off the bat. Leslie Norton is going to lead us on this panel. She's the editorial director for sustainability for Morningstar. I'm a big fan. I've been following you for years. John Hale is the director of sustainability research for Morningstar. And Carole Laible is the CEO of Domini Impact Investments. They have been doing this for a while. They are the originals in this game. And I am Caleb Silver from the editor-in-chief of Investopedia and host of the Green Investor podcast. I'm going to take my seat, and we're going to get after it.
All right, just give it a quick second. They're having some online pauses, and then we'll start.
And I think we saved you.
Thank you. Am I missing somebody?
We're good. No, you're good.
Nope.
Go ahead.
Yeah.
Welcome, everybody. It's really a delight to be here, and thanks to you for coming and for our previous panelists as well for giving us such an interesting panel. Sustainable investing has obviously been one of the most popular trends, right, in investing over the past 5 years. It's been shadowed by a cloud over the past year, as Caleb described. You've seen concerns about greenwashing. It's been accused recently of being woke capitalism, as well as a tool of manipulative CEOs trying to impose their liberal values on America. Recently, the state of Texas decided to ban certain investment managers who practice sustainable investing from managing its public pensions. That affects one of the panelists here, but I'll let her tell you about it. Now, Caleb already described the title of our panel. We have an excellent lineup of people to unpack this subject. So let's just go ahead and start off. John, you know, we're now navigating through a time when ESG is perceived as controversial. Tell us what's happening in this space during this period.
All right, well, you know, I think it is obviously true that ESG is seen as controversial in some quarters. We've seen it in politics recently as, you know, right-wing politicians have been attacking ESG. I think when you look inside the investment world and even among corporates, ESG is not nearly as controversial of a subject. It's one, however, that carries with it a fair amount of confusion. You know, both I think among investors and I think maybe to some degree among corporates as well. But you know, I think we'd all you know, get a better handle on the whole thing if we kind of made a distinction between ESG as a process, a part of investing that's become a relatively mainstream component to the way investors make decisions, ESG as process, and ESG as product, or and there I like to, instead of calling it ESG product, sustainable funds, as two different things. I think when you look at ESG as process, that most investors will tell you, most asset managers and fund managers will tell you that, you know, gee, you know, ESG is a set of information that we have, a set of metrics, ratings of companies and so forth that help us develop a bigger, more holistic picture of an investment for the decisions we make. And ESG analysis is simply the interpretation of that information in order to make a good investment decision. And, you know, I can just tell you that when you look at any asset manager, really of any size or significance in the world today, almost, you know, all of them are incorporating ESG into their process in that way. So it's not controversial per se. It's one of these things that everyone's doing, although it's happened very quickly frankly. I mean, if you know, go back 10 years or so, and the kind of ESG information that we had was, there was some there, but it wasn't nearly as sophisticated or voluminous as it is today. And there certainly wasn't as much ESG, you know, analytics happening within mainstream investing. But a lot of the, you know, criticism of it is really just, you know, professional investors doing their thing, trying to account for their, you know, fiduciary, or live up to their fiduciary responsibilities to look at all the risks, all the material risks that might be embedded in a particular investment or investment decision that they need to make. So it's nothing, there's not values, it's not politics, it's just professional investors doing their fiduciary duty. That, you know, that's process. On the product side, it's a little bit different. There's a number of sustainable funds out there today. Going back to about 2015 or so, we had about 100 of those kinds of funds available to U.S. investors. Today, there's about 600. So there's a lot of them that have come up recently and launched recently. The key thing, I think, to remember about those is that it's not so much ESG per se. A lot of them use ESG analysis, just like traditional investors do, or other investors. But these funds have kind of a dual objective, I would say. They all do want to achieve competitive returns. They are investments, after all, and they're investments in at least in what I'm talking about right now, in public stocks and bonds. So, you know, they aim to deliver competitive investment returns. But in addition to that, they want to do that with an eye towards, like, you know, what is the overall impact of what we're doing on people and planet. That's the sustainability part. And so these kinds of funds come at those objectives in a variety of different ways. So one ESG fund, that would be my message on this side of things, is like one ESG fund or sustainable fund is not necessarily like the next. And so you have to do quite a lot of research under the hood. You can't just assume, oh, I've got 600 choices here, I'm going to go to, you know, Vanguard or iShares or some, you know, recognizable asset manager and just pick on the basis of that, or on the basis of, you know, fees, and that's it. You're liable to be disappointed. And we do have, I think, a fair number of investors who have, you know, piled into a lot of these funds over the last few years, who are who may see something like, you know, XYZ company in the portfolio. They might see ExxonMobil in an ESG portfolio and say, oh my God, what is this doing in this portfolio? I can't believe it, this is greenwashing. Well, you know, look under the hood. It might be the case, as it is the case with some ESG funds, that they're taking a basic benchmark index and they're overweighting companies, right, that do better on ESG analysis, underweighting those that don't, but they're all still in there. You know, so that's just one approach that a few funds use. That, you know, that something like that happens, it makes headlines, and we get all kinds of, you know, claims that ESG funds are greenwashing. And really, I think, you know, the key takeaway there is that, you know, you got to look under the hood to figure out what they're actually doing, because they're doing all kinds of different things in order to achieve those dual objectives.
Caleb, I want to ask you something. You know, you deal a lot with individual investors. You host a podcast that's about climate and its intersection with the markets. You know, among these investors that are concerned about climate issues, that want to invest sustainably, is greenwashing a big concern?
I don't think it is as much as them really just trying to figure out how to invest in alignment with their environmental sensibilities or with their consciousness. So we get a lot of questions on Investopedia about what really is ESG, what are the criteria, how do I invest in climate, in companies that are trying to reduce climate change or global warming. So it's the how-to and then the unpacking of that. We did this survey last year with Treehugger, one of our partner companies here at Dotdash Meredith, about what people thought of it and what they thought ESG meant and what brands they associated with it. And to your point, a lot of brands that you wouldn't necessarily think fell into that bucket because they had that perception. Tesla, obviously it makes EVs, batteries for EVs and electric vehicles, but it's got some societal and governance concerns, but people think it's a green company because it makes EVs. and unpacking that and really understanding the rules of that, it's still confusing for a lot of investors, although there's undoubtedly this wave and this movement of people who want to align their money with their beliefs.
Right. Well, this gets us to the question of impact, right? Carole, I'm going to ask you to address this because, a lot of the confusion over the past year, people, sort of assumed, or some people assumed that an ESG fund was supposed to deliver impact, and whoa, lo and behold, they discovered that it didn't, that the ESG fund was investing in companies that were trying to avoid risk, but not necessarily, trying to deliver particular societal outcomes. So tell us about impact. Tell us, is this a part of what you do? Is this part of ESG investing as we understand it now?
Thanks, Leslie.
Sure.
And thanks to John and Caleb for presenting alongside of me today. I think John hit the nail on the head when he was saying, there's work to be done as you're approaching a sustainable investment product to decide if it's right for you. I don't think it needs to be overwhelming. At Domini, we say when thinking about impact or ESG or sustainable, think about it less of what you call it and more about what you do. So we think about impact as you have 3 levers you can pull. The first is to include environmental and social standards in your investment process. So we think about that application of those ESG standards under an umbrella that we refer to as being better investors. The second is now that you're an owner of these companies, you have a voice at the table, and you can create change where you see weakness. So Caleb referred to Tesla, a company that is electrifying the automobile fleet and changing the way we all drive is very powerful. So having that seat at the table and approaching them about some of the employee issues that they're facing gives you another level of impact. And we put that under an umbrella, which we call being better owners. And then the third, and we think critical to the infrastructure and thinking about it as a system level, is to invest in communities. Sometimes people are a little confused by that. How does that impact my portfolio? Well, we think all portfolios have to be built on a sound financial system, which includes fairness and justice for all. So channeling money, often through fixed income, but also through diversified financials, banks, insurance companies, is a way to help us build healthy, vibrant communities. And we put that under the pillar of being better neighbors. So being better investors, better owners, and better neighbors are the 3 tools that ESG has as a strategy. And the question you should be thinking about as you're approaching each product is, how many of those levers do they use and to what degree?
Mm-hmm. Thank you. Carole, I've got to ask you this. Your funds are now being disqualified for investment by the state of Texas. What an outrage. So how has that affected your approach?
So I'll say, frankly, it hasn't. Mm-hmm. And I think that's reasonable. Our standards, we at Domini, we apply one set of standards to all of our mutual funds. So we don't change the standards depending on the product. We really think about them as a brand and apply them across all of our products. So to be very transparent to all of our investors and to also serve as the backbone of all the work that we do, we publish those standards on our website. You can download them as a PDF. They're about 70+ pages long. And they provide very detailed information about what we're doing in our approach. Again, as John says, going back to giving the investors those tools to decide if this is a product that's right for them. we think that this detailed information is what draws a lot of our investors to us. Our approach of excluding the energy sector, not only refiners and producers, but also those companies that service them, like transportation companies or storage companies, very closely connected to that activity, are excluded as well. So we think that providing that detailed information, putting those standards out there, and really letting the investors decide whether our approach is the right approach for them will continue despite the Texas action.
Okay. Yes.
Well, I think it's really important for sustainable funds to be very transparent with their investors. I think if you look at it, kind of think of sustainable products more generally, and the tremendous demand that's out there for sustainable products. There's so many, so many of us are making, well, for many of us, sustainability is kind of a component of the decisions that we make in all facets of our lives, whether it's consumer decisions, whether it's lifestyle decisions, career decisions. It only makes sense that it would also happen with investments. But I think for any kind of product that's making a sustainability claim, we're dubious, right? You're sort of like, we want to guard, you mentioned greenwashing, we want to guard against, we don't want to be taken for fools, right, about selecting a product that says it's sustainable. So we want the proof, and, a product really only has, one chance there to, like, okay, when somebody's on the hook here getting ready to buy this product, we need to demonstrate our credibility when we claim that it's sustainable. And I think what's happened with a lot of funds, a lot of them have launched very quickly, and some, frankly, from large asset managers who, this might be the one single sustainable or ESG fund that they have in a lineup of, hundreds of funds. And they just really haven't attended to that challenge of saying, here's our case. Here's why this particular strategy is sustainable, and why somebody that's interested in this, can be comfortable, buying this product. And so I think, transparency on the part of the fund products is very important, and making very clear what approach or combination of approaches that they use, is what the end investor is going to get when they purchase this product, essentially.
Well, let's talk about some of those approaches. I mean, you actually hashed out a framework that had 6. There may be more than that, but these were 6 basically. What are they, and how do you see them reflected, say, in Carole's fund?
Yeah, well, so we've already talked about ESG analysis. I kind of broke that down into 2 different kinds of approaches. One of probably the most common way to use ESG information in an investment like decision-making context is in terms of risk management. You talk about, like, what are the material ESG risks that a particular company faces or particular industry faces. So a lot of investors are using, ESG in order to help them manage risk or get a more complete picture of the risk of an investment. That happens across the board. When I was saying before that it's kind of a mainstream activity now among investors, that's a very common, the most common way of using this ESG information. But sustainable funds often also use it to identify opportunities, to focus on, like, how does ESG information help us find the sustainability leaders industry by industry, for instance. So that's another way of doing it. So risk, opportunity. Exclusions, everybody's probably heard of exclusions, and it's kind of something that's been happening for a long time in these types of funds, but there could be out-and-out exclusions that are used. And a lot of ESG or sustainable funds have a list of certain exclusions of types of products, or, in some cases in fossil fuel industry, complete exclusions, although not all. do that. So that's another one. So exclusions, risk, opportunities. There's sustainability themes, a thematic approach. Domini has a fund like that, Domini Sustainable Solutions, right? So it's focusing really on sustainability as a long-term theme. There's focuses on renewable energy and clean tech and those sorts of things as well. Some funds are really more focused on impact than others in terms of like how do we assess the overall impact of the holdings that we have in our portfolio and how do we communicate that to our investors. So that's another approach. And then finally, engagement and proxy voting and things like that, focusing on trying to further ESG improve ESG behavior at companies that you own in your portfolio through engagement and proxy voting. This is something that's happened for a long time. Going back into the 70s and 80s, but at the time there was a very small number of people doing this. You usually, frankly, had to bring a group of Catholic nuns or something with you to the table in order to get to get the companies to actually decide to have a meeting with you about this. Today, it's like so different that companies today are themselves very interested in ESG. They're very interested in how ESG assessments help them kind of understand how to shift their approach to the business towards more of a more sustainability, more long-term focus, more focus on all the stakeholders that the company serves. And so they're very receptive today to engagements. It's not some kind of adversarial thing as it kind of used to be in the past.
So, we launched, so as a firm, we've been focused on impact investing since our inception and launched our first fund in 1991. So we've been at this for 30 years. And as John says, the change and the evolution has been remarkable and rewarding in many ways, but often those trusted dialogues where they really value the input of the environmental and social expertise as a way to help them guide their business is a great layer for impact and change and reporting out on what difference a dollar invested in a sustainable mutual fund has made. When you have these successes, they're really very tangible and easy to see.
Mm-hmm. Yep.
Caleb, many investors are interested in specific themes or in single issues. How do they invest around these themes? What would you advise them? How are you guiding them in the articles that you publish? Or is it better to pick a broad, sustainable fund?
Well, to their points, there's a flavor for almost any one of these themes, and there's an ETF for that, for sure, or there's a good mutual fund you can buy as well. So you can really pick your themes and go really deep on that theme if you want. He mentioned climate tech, water tech, water purification, food tech, agri-tech, that's becoming very big. So our readers are interested in all of these things. We have a lot of readers. They all come from various backgrounds, but they're looking at approaches to the things that they're passionate about typically. And then there's the overarching investor who's not necessarily that interested in particular themes. They're just interested in, again, in aligning their dollars with their beliefs. Mm-hmm. And they don't want to be in certain sectors, or they want to be able to screen them out. So we're seeing the rise in popularity of tools like Canvas and others that allow you to do screening, take things in or out of your portfolio, or add a little bit here or add a little bit there. People are interested in learning more and more about that. But I would say there's this, pretty decent chunk of people, and I think it's most people, who just want to do right. And they just don't want their money going to things that they don't believe in anymore. So either they're going to find that ETF that excludes it, or they're going to find the ETF that concentrates, or the index fund that concentrates on the thing they want the most. And then we have folks who want to be actively invested in companies like activist investors like Engine No. 1 and others who want to own shares in companies so they can have a voice in what they do. And you see more and more folks getting into that because they want a seat at the table. They don't want to just say, I'm just not going to put my money there, because some folks don't believe that is a solution.
Right.
And I'll just piggyback a bit on Caleb's remark. where we find when we're building our Domini impact investment standards, we're using the lens of what the classic impact investor is looking to implement in their portfolio. So often an investor will come to us with one theme that they're looking to hit, but then they'll see through the standards, oh, I'm going to get all of these other things. And I've had investors say, oh, we get all those other things for free. It's like, I'm getting the thing I want plus more. And another thing that we've heard through studies and surveys we've done with our shareholders is that they trust the expertise, that long-term historical perspective on these issues. They want to leave to the expert and not try to make that decision on their own. And there are great tools to do that these days.
That's great. In fact, you've sort of answered this question, but I'm going to pose it nonetheless because it's a question that's repeatedly asked in every article I currently read about sustainable investing. So can you really make a difference in the world if you practice sustainable investing?
Yes. We are very committed to reporting out to our shareholders on both a quarterly and an annual basis on what difference a dollar invested in a Domini fund has made. That is a really important answer for investors. And that's been part of the evolution. So when we first started 30 years ago, the first question was sort of like, well, how are we going to do this? Where are we going to get this data? Well, now we have lots and lots of data thanks to kind of the pioneers in the space requesting the data. We have tools to measure and manage and make the evaluation on whether a company meets our standards or not. The second question was, well, how would it perform? Is this going to cost me money? And luckily, with 20 plus years of data now and lots of studies and meta-studies and studies of indexes and studies of funds and studies of companies, we see that it can perform competitively. So there is not an inherent cost and there's not more risk that needs to be taken on, but you have to do your due diligence and be careful about, just like any other investment product, who's managing your money. Then the third and most recent question has become, well, what difference does it make? Where can I see the results? What are you doing? And that was what really pushed us to put that quarterly and annual reporting out there. We do report out. I think we had a breakthrough in 2017. Initially, we used to just report out on the investor dialogues with the corporations. How did we get them to change in a way that was positive? And we thought, well, we were missing the boat. We weren't really reporting out on all that we were doing in applying standards or all that we were doing on investing in communities. So in 2017, we did an overhaul on our reporting. We report out now under all three pillars. Our marketing department has reined us in. I think in 2019, we hit an all-time high of a 140-page annual impact report. They said, no, 40 pages, that's it, do the best you can. So we report out quarterly. It's about 8 pages, and on an annual basis, about 40 to 50 pages. And it's enough to give investors a flavor of what their investment is doing, and certainly if they contact us and want more information, we're always happy to share.
Okay. I know you want to add to this, but I was going to ask Caleb first. I mean, when somebody asks you this question, how do you answer it? With the question being, can you really make a difference in the world if you practice sustainable investing?
Yeah, I mean, again, with those very directed types of ETFs or companies, if you want to invest directly in those companies, then you can actually see where your money's going, and you can actually see how the company's putting it to use by following up with that company. Same thing with ETFs, although it's a little bit wider. It's a little bit more of a scattershot approach. But I think performance has been the big question for years, and then it really kind of went away until we had this super cycle and commodities kick in. And then all of a sudden everybody's wondering, well, I've been out of the market, I've been out of energy stocks, traditional energy stocks for a while, and I've missed pretty much the only returns that have been available in the stock market. How deep is my conviction to investing along with my environmental beliefs when I'm missing out on returns? And this has really put the industry to a test. Plus the regulatory issues that may be coming down the pipe. A lot of this is really making investors ask themselves that very hard question. You said you believed in it. This is where you wanted to put your money. Now you actually have the opportunity to defend that in the face of rising commodity prices, a lack of performance by a lot of sustainable and ESG funds, and the fact that there may be regulation overcoming this entire industry soon.
And I think it's important to acknowledge that environmental and social research is really a matter of looking at trends and patterns over time. So in its nature is really looking out over a medium and long term. There will be short-term volatility. So I think when you're approaching it, you have to acknowledge that and have the investment goal so that you can ride that out over a longer term. You know, if you look at energy, we find it goes up and it goes down, but it's fairly neutral over the longer term. And our exclusion of energy, yes, has huge environmental impact, huge social impact, but we also believe it's going to have a huge financial impact because, frankly, if we burn all of the oil we have in the ground, we won't have a planet to live on. So at some point, the party's going to come to an end. Right. How and when is an important consideration. So long-term lens, you know, riding out some of the cycles, and it's been a tough one when energy was the only thing performing, for sure.
John, you wanted to add something really quickly, and then we have to move on to our next questions.
Well, I mean, one of the things I think I wanted to add about impact was that if you look at the amount of money that's gone into sustainable funds and the amount of attention that asset managers now pay to ESG information and analytics, it has sent a giant signal to corporates the world over that ESG matters are important to investors. And corporates have heard that. They've also heard that from their other stakeholders, their employees in particular, and customers, and partners, and you know, community, everyone. But when investors also weighed in and said this is important, it has started to change corporate behavior, and it's a massive, I think, paradigmatic shift away from shareholder primacy as the focus of corporate management to stakeholder value and the long-term perspectives that go along with that. And I think so. I think it's been a major impact. I think other things have you know, contributed to that as well. I mean, facts on the ground contribute to climate change in particular. But ESG, I think, has already had a gigantic impact because of that. And then kind of a little more prosaic, the impact of the ongoing engagement and the proxy voting that kind of helps enforce to companies that, yes, this is what your investors think about these issues has also been very impactful.
That's great.
And I'll just tack on, I know we're going to move on, but you can think about the impact. You know, a lot of people want to do counting, you know, that's a logical thing to want. But I think when you're thinking about impact, it has to be both quantitative and qualitative. So we can measure through carbon footprinting that our portfolios are less carbon intense than others. But there are times when you're looking at an issue that it has to be, as John is saying, you know, a full stakeholder evaluation of, is life better? If you have as much money as possible in your account, but no clean air to breathe or water to drink or your house underwater, you know, that's the overall well-being and the impact that needs to be measured.
Right. One of the points that was raised in the previous panel was that, you know, a big way to build wealth is by reducing your costs. So, you know, this has given rise to the, you know, active versus passive conversation. What is it in sustainable investing? How does that conversation go? what's the, what's the best way to invest? I'm going to start with you, Caleb.
Mm-hmm. Well, you could take the basket approach because there's an
Yeah.
ETF for that and everything else you want to put into it. If you care about wind.
Active management is also a basket approach.
Yeah,
right.
You could take that as well. There are managers, active managers that do this for a living. They've been doing it for decades and they're excellent at it. So you could take that approach, go with a name you trust. People have been in this business since basically the theme started. Or you could really pick your theme. And if it's wind that you care about, or if it's solar, there's plenty of ETFs out there that offer that, and they've been doing very well, by the way, and especially since the Inflation Reduction Act lately. So you can pick your theme, you can pick your company. I think for beginning investors or people who are just starting out and exploring it, I think ETFs and index funds are the way to go until you sort of get a sense of what works well for you and what feels right in your portfolio and what you believe in long term that's going to stick with your conviction no matter what's going on in the market. I think that's the easiest way for a lot of folks to get into it, and it couldn't be any easier for them to do it. So I think that's where I would start if I was beginning. Now, if you're a more sophisticated investor and you want to interact with your portfolio managers and you want to talk to your fund managers and be involved in those conversations, then go with a fund like Domini. Go with one of these established funds that really knows this and has connections within the industry and can get to management of the companies that they're either taking stakes in or that they're actively not taking stakes in because they have a seat at the table that you want.
Right. John, let's talk about the active versus passive conversation.
Yeah, I mean, I think that ESG information and analytics clearly has the potential to improve active management more than it does to maybe improve on a passive vehicle. If active managers are using the information, in a way that helps them understand and make better investment decisions. So that's the active side. I think there's a case to be made for it. The passive side, I think, is interesting because the fact that we now have so much data, ESG data on companies and ratings and so forth, it's enabled the creation of a number of passive indexes. And the issue to keep to keep in mind as an investor is that one ESG index fund is not like the next. It's not like S&P 500 fund that's the exact same, vehicle no matter what asset manager is sponsoring it, and all you have to do is maybe look at the tiny little incremental difference in fees. So you got to look under the hood of an ESG fund. Some of them are optimized to, like I was saying before, they just sort of overweight a base index. They'll overweight the better performers, underweight the worst performers on ESG. And so you've still got the Exxon Mobils in there and a lot of companies that you may not like. Other ESG index funds have, they differ in the exclusions that they build in from the beginning. So they do that. The others actually try to engineer the portfolio so that it doesn't perform really any differently than a standard benchmark that it's like. So you're, maybe getting this sustainability, effect by buying the fund, but your performance is going to be almost exactly the same as an underlying index. So you really got to, there are flavors, so there are differences in the indexes, and then there are differences in the index managers too. There's a manager like say Calvert, which is a ESG focused company and has been for a long time, who has indexes, but they're also very active in the engagement arena. Another, ESG index fund out there may not do anything really of note on the engagement front. So that's another dimension to look for in looking at index funds for ESG.
Good. We only have a few more minutes left, so I'd like to ask you if you have any questions you want to address this panel. Do we have anything online?
We have one from online.
Okay.
So we now have 2 comments actually in the virtual area about people investing for returns versus ESG. How can investors strike a balance? When does it matter? Or rather, is there a way to maximize ESG investing returns? I realize that's a large question, but we'll try to do that in a few minutes.
Love to hear from the pros on that.
Yeah, I think that goes back to the data and a lot of the studies that we've seen, which is there is not an inherent cost, but you have to be choosing the financial approach that makes sense in terms of your investment time horizon and your investment goals. So if we break down the performance question, I think it was Nuveen that did a study of ESG indexes versus regular indexes, and they found there was no performance cost and there was no additional risk to take that on. We've seen, an ESG level study out of Harvard Business School that showed that at a company level, companies that pay attention to the key sustainability challenges in their industry outperform their peers that don't. So that's at a company level. So if you think about it at a market level and a company level, performance can be produced, but certainly looking at who's managing your money and what is their approach, and does that align with your goals and your time horizon is an important piece of it. So it's, like any other financial product, there's not an easy answer, and it's very personal to your investment strategy and approach.
Yeah, and to John's point earlier, a lot of the top ESG funds look a lot like SPY, look a lot like the S&P 500. You're going to find a lot of the same companies in there because they may score high or in some areas of the E, the S, or the G, but maybe not in some others. But you're going to see a lot of Alphabets in there. You're going to see a lot of Microsofts in there. You're going to see a lot of Amazon and Apple in there as well, and Tesla, because they score highly in some of these areas. So you really want to get into it and be passionate about the theme you're going to invest in. You have to do the homework. You have to look at the ratings. You have to look at what's inside these companies. Morningstar's got great tools with that. Sustainalytics is part of the family, I know. Those are great tools, and that's what you have to do the homework in this theme if you want to go deep.
And just one thing to add to that, you need to compare the fund to other funds in the same investment category more broadly. So if you're looking at a large cap US core stock fund, look and see how the ESG fund has done relative to the others. There's plenty of them that have done quite well over time, but they do different things. They have different financial approaches too. That's one thing I didn't mention earlier, is that all these different approaches to ESG, you have to marry those together in a fund strategy with this kind of standard financial approaches. A lot of them are fairly growth oriented, but there's no rule out there that says you can't have a value oriented ESG fund, and there are some out there. So you got to look at that side of it too. I'd say compare them with their traditional fund peers to assess performance, and you'll generally be able to find, I think, a lot of pretty good performers in that kind of comparison.
That's actually all the time we have. So thank you so much. Please join me in a round of applause for our fabulous panelists.
Thank you. Maybe they'll stick around for the reception and answer more questions if you have them in person, but please, thank you. Thank you, Leslie.
Thanks.
Very great.